Okay, so here we are once more. The first annual reports have been published. In this video, we'll take a look at the top 10 stocks that the world's top investors were purchasing in the years leading up to 2023. There's a lot to cover in this video, so to make sure I get into enough depth to make it worthwhile. Welcome back to Financial Fortune. I'm going to quickly run through stocks 10 through 6 to set the stage, and then we'll devote a lot more time to discussing the actual top 5 stocks. With that said, let's launch into action. Stocks 10 to 6. So, coming in at number 10, we have Capital One Financial, a big bank and credit card provider operating in the US, Canada, and the UK. Then at 9 is Brookfield Asset Management, which was notably bought by the one and only Mohnish. Although this one is a bit of a false positive because Brookfield Asset Management was spun out of Brookfield Corporation in Q4, and the shares of Brookfield Asset Management were distributed to the shareholders of Brookfield Corporation. However, Dataroma is still registering those as new buyers, even when they aren't really. This, however, is Brookfield. And then going on to number 8, we have Bank of America, of course. The big behemoth American bank that sits as the second largest position in Warren Buffett's portfolio. The 7th spot goes to Apple, a company that is a major player in the consumer electronics industry. If you aren't familiar with Apple's business model, you're better off buying an index fund. While Apple's stock continued to plummet in the fourth quarter of last year, 8 superinvestors still managed to buy. 6th on the list is Salesforce, which offers the most popular CRM software in the world. Their stock also created towards the end of 2022. So not surprising that 8 of our super investors were buying it. Stock 5. Having said that, let's not rush things. Relax your grip on the accelerator. Let's spend some time delving into the top 5 stocks. With 8 purchases from super investors, Disney ranks number 5 for the quarter. Therefore, the fact that Disney stock is included on this list is likely attributable to the fact that it recently hit a 52-week low of $84 per share near the end of Q4. Even more noteworthy was the fact that former Disney CEO Bob Iger would be succeeding Bob Chapek as Disney's leader for another 2 years, making the announcement during the fourth quarter. Investors in Disney were likely relieved to hear this, as the company had a rough patch during Bob Chapek's tenure as CEO. Of course, it wasn't entirely his fault. It was just a rough period to be running the biggest entertainment company in the world. Nonetheless, Bob Iger has returned, and he faces a massive task over the next few years. Even though Disney appears to have weathered the worst of the covert blues, the company is still contending with a macroeconomic climate that is causing consumers to cut back on discretionary spending, which includes, alas, everything Disney sells. Bob Iger has recently announced that they will reduce costs by eliminating over 7,000 jobs in an effort to counteract this impending doom. However, I believe that this is more of an effort to win back the trust of investors than anything else. Disney's dividend may be reinstated in 2023, which is an intriguing possibility. Now that Disney's current leadership has been replaced, all eyes are on Bob Iger's plan to restructure the company for the future, which may include selling off some of Disney's businesses to make it a leaner, slicker machine for the future. One example is the widespread belief that ESPN is up for grabs. Recently, Bob Iger announced that Disney would be splitting into 3 revenue segments, with ESPN forming its own division in addition to Disney Media Entertainment and Distribution and Disney Parks Experiences and Products. Yes, that's a fair question, but I believe that the combination of the stock dropping significantly in Q4, Bob Iger returning to clean house, and Disney having gotten past the majority of the covert blues was enough to entice our super investors to buy during the previous quarter and turn to simply Wall Street. Additionally, we can see that Disney is currently undervalued based on their built-in discounted cash flow model. This, of course, does not imply that you should go out and buy Disney stock. This does suggest that Disney may be one of the stocks you investigate further over the next 2 weeks. Stock 4. Microsoft ranks 4th in terms of market share. In the previous quarter, 11 of our 79 super investors purchased Microsoft stock. Why? Okay, this time. I believe this is because our most astute long-term investors likely saw an opportunity as the broader market sell-off dragged down technology stocks. They will purchase Microsoft stock if they believe the stock price is below the company's true worth. They aren't day traders, rather, they plan to purchase the company for the long term because of its proven track record. The release of OpenAI's ChatGPT on November 30th was also significant for Microsoft during the fourth quarter, and not just because of the impact on the company's stock price. In 2019, Microsoft put $1 billion into OpenAI and has just announced an additional $10 billion. Their financial backing of OpenAI represents a concerted effort to speed up the creation and dissemination of AI-based tools. Microsoft has invested in OpenAI in order to gain access to cutting-edge artificial intelligence (AI) research and development resources. Microsoft will be able to use OpenAI's knowledge of artificial intelligence research and development to enhance existing offerings, and create brand new offerings with AI that will be of value to the company's clientele as a result of the partnership. You may have guessed that last paragraph was written entirely by a ChatGPT, which is proof of the technology's potential. Thus, there is no doubt that this has captured the world's attention, and Microsoft is in a very strong strategic position to collaborate with OpenAI to bring this next big technology to market properly and to monetize it. Bing now has full support for ChatGPT, and the search engine's popularity has skyrocketed as a result. Also, ChatGPT Plus is in the works, and its expected $20 monthly fee is already being factored into the planning stages. So, that's what all the fuss is about with Microsoft right now. Beyond the realm of artificial intelligence, however, lies a great enterprise with a wide variety of software-based operational modes. Even though Simply Wall Street warns that the company isn't exactly dirt cheap right now, I think it's still fascinating as a subject for study. Stock 3. Here we have at number 3 a name that has sparked much debate, Meta. So, in the years leading up to 2023, 13 of our top investors, including Seth Klarman, who increased his holdings by 150%, purchased Meta. Okay, so where do we even begin with Meta? First off, it did plummet precipitously in the fourth quarter. Shares had dropped to a new 52-week low of $88. Of course, our most affluent investors would be doing quite well now if they were purchasing it heavily back in November. Few months later, they are still selling for $170. Nonetheless, the core of the same story with Meta remains. There are many obstacles in their path at the moment. And yet, Mark Zuckerberg remains dedicated to the Metaverse VR/AR project, which is bad news for financiers. Meta's losses from Reality Labs reached $3.7 billion in Q3 of last year, and $4.3 billion in Q4. Beyond that, in 2022, their annual capex reached $32 billion, up from $19.2 billion the year before. This means that a lot of money is being invested at the moment, but it has not yet produced any tangible results. However, that isn't all, we've got that covered, too. The macroeconomic climate is also exerting significant influence. They are not having financial difficulties, as far as I know. But what's happening now is that advertisers are cutting their marketing budgets, which is a blow to Meta's revenue. Their revenue increased by just 4% in 2022 compared to 2021 when measured in constant currencies, and while their ad impressions were up 18% year over year, their ad costs were down 16%. Short-form video, which is much more challenging for Meta to monetize, and the general decline in advertising spending are the primary causes. Thus, there are many near-term headwinds, but our long-term focused super investors clearly brought up a lot in the fourth quarter, so they're obviously not worried. Fair value is estimated to be around $200, which doesn't surprise me because of what I saw when I checked Simply Wall Street. Thus, $88 per share in Q4 obviously reflects a very steep discount if the super investors were looking at it. Though you should never buy something solely because of what it says on the internet, this one seems to indicate a sizable gap between the asking price and the actual value. Stock 2. Moving on to the company that was the second most popular among Q4's super investors for stock purchases, Amazon, the trend continues. Amazon stock, like many others in the tech industry, took a nosedive at year's end, plunging to lows not seen since 2020. So why? You have to realize that Amazon relies heavily on consumers' propensity to spend money. You know, Amazon really did well when the lockdown began and the stimulus checks were distributed. Their income has increased dramatically, but as everyone knows, inflation and price increases occur when people have less discretionary money. Amazon isn't doing too well. Over the past few years, we've seen Amazon pour a lot of money into the company in an effort to prepare for the level of demand expected in 2020 and 2021. They have increased their capital expenditures from $16.9 billion in 2019 to more than $60 billion over the past 12 months. But has it really cost that much? Consumer spending has dropped significantly, making the situation more difficult. Retail is a relatively weak spot for the company. AWS, however, is a growth engine that is currently saving them. Despite lower operating income in 2022 from both their North American and international retail segments, Amazon is still able to find some bright spots thanks to the growth of their AWS division by a factor of 23. Plus, basic Wall Street valuations still show them to be relatively undervalued, so this stock may be worth looking into further. Finally, we've reached the pinnacle. Our top-tier investors have been piling into drumroll, please, in anticipation of 2023. Stock 1. Google did it. Google's stock price fell throughout Q4, and, interestingly, it still hasn't recovered much as we begin March. So, while Google does dabble in many different businesses, the vast majority of its revenue comes from advertisements. Also, they, like Facebook, are feeling the current headwind of advertisers cutting back on spending. In the fourth quarter, advertising revenue fell year-over-year, which is an unusual occurrence. So revenue growth was lower than the 20 to 30% we had anticipated, but the number of employees rose from 156,000 in 2021 to 192,000 by the end of 2022, as shown in the same chart. So, basically, it's the same story everywhere. You are aware that consumers have less discretionary income because of the macroeconomic environment. Because of this, corporations in the United States will have less money to spend on marketing, which will have a negative effect on Google's advertising revenue. So, lower revenue, but at the same time, higher expenses as businesses look to expand following a huge 2021. That's why right now, you'll see a lot of companies increasing headcount a lot year-over-year, while at the same time you'll see media reports of basically every company under the sun just doing layoffs. Fortunately for Google, their rock-solid mode and the results it has had on their balance sheet mean that they are not in a particularly precarious financial position. As an example, Google has $113 billion in cash and short-term marketable securities as of the end of the third quarter of this year, which is $26 billion less than the same period last year, but still $113 billion in total. With only $13 billion in long-term debt and a total of $109 billion in liabilities, it becomes clear that Google is a financial fortress. So that's the deal with Google. I've been reading on Simply Wall Street that discounted cash flow does hint at potentially discounted valuation, and with Li Lu dumping a lot of cash into the stock in Q4, it's one I'll be coming back to in the coming weeks. Okay, so those are the top 5 super investor buyers for the fourth quarter of 2022. I'm glad it was entertaining. If you have subscribed and would like to see more videos, please indicate your interest by clicking the like button below the video. That's all for now, folks. I'll catch you in the next video.